Tax-free money, infinite banking, guaranteed return. You might have heard of a lot of these different things that are happening out there. So I want to talk about the conspiracy of life insurance and why it might not be the greatest investment vehicle that all these agents are talking about. Hey, how's it going again? It's Eric, your Abundant BFF, and as always, I am here to help you find freedom and abundance. Today on The Conspiracy of Money, let's talk about life insurance, what it is and what it's not. A lot of folks out there right now, there's an abundance of financial planners that are out there looking to sell life insurance. And if there's anything that I've learned over my years of being in the financial marketplace and as a financial planner and even a life insurance salesperson, is the conspiracy is it's more of a money grab for life insurance companies and life insurance agents than it is for you. So let's talk about how life insurance first came about and what life insurance is. So life insurance first came about back in the early Roman days when there was a Roman military leader who created a burial club for all his friends in the military. So if somebody died from an unforeseen happening or an unforeseen event, all the homies would get together and help pay for that person's burial. Because there's a Roman belief that if a person was not buried properly, they would be a very unhappy ghost. And nobody wants an unhappy ghost, right? So life insurance has developed over all of these years, and in America, it really started coming about in the 1800s when companies like MassMutual, Northwest Mutual, and companies like that really sprung about, creating what we call death benefit policies. Where basically what it means is you pay for an insurance premium over a period of time, and then when you keel over or you kick the bucket, the insurance company will pay out your beneficiaries a lump sum, or what they call a face value, a face amount, to help cover your burial costs. And as life insurance started evolving, people started realizing, hey, maybe I need a little bit more than $10,000 or $20,000 for my burial when I die. Maybe I want the insurance to cover things like my mortgage or to cover living expenses for my kids or my spouse or what have you when I die for an untimely reason. So life insurance kept developing, and they started creating two distinctly different kinds of life insurance products, just so that we're all on the same page. The first most common one is called term insurance. Term insurance is basically an insurance policy that lasts for a definitive period of time, typically 10, 15, 20, or 30 years, and usually it's wrapped around like a mortgage or something like that. And the whole idea is when you get 30 years through your insurance policy, by that point, hopefully you've developed enough of a nest egg or retirement account where you don't need life insurance anymore. Term insurance policies typically are the cheapest because there's no cash value. It doesn't build any value to it. It's just a death benefit. The moment you stop paying a premium, the insurance ends and it lapses. The second style of life insurance policy out there is what they call cash value or permanent life insurance. Cash value policies basically have a fundamental factor where a portion of your money goes to a cash value and a portion of it goes to the cost of insurance. Typically, a cash value policy costs 3 to 4 times more at the very least than a term policy, but the whole notion is it's designed for your entire life. So if you keel over 96 and you've been paying your policy since then, you'd have insurance coverage. But also, what a lot of salespeople, myself included back in the day, would sell based upon is it was a way to invest and save your money. And the whole idea is you'd put money into this policy, it would grow on a tax-free basis, and then you withdraw the money through a policy loan, and then when you kick the bucket, the death benefits are tax-free. So fundamentally, life insurance is designed like car insurance or like health insurance to cover an unforeseen. We all know we're gonna die at some point, but if you die earlier than you think you would have, to cover your expenses, you'd use life insurance. So that's fundamentally what it is. Now, there's a lot of financial experts, and I'm gonna use air quotes, right? As a tax advisor and as somebody that's been in this space for a long time, there's a lot of financial experts out there that are using life insurance as an investment vehicle. They're talking about utilizing life insurance as a way to save money. And I'm gonna tell you, that's probably not the most beneficial. Now, why is it that way? Typically, when you're operating a savings vehicle within a life insurance policy, you're paying a very high premium on a monthly basis, so that way you're funneling money into a cash value policy. Now, when I was selling life insurance back in the day, I got really savvy, As an insurance agent, you provide what we call illustrations to a client and say, here's what it looked like if you saved X amount of dollars in your policy over a certain period of time. Now, the insurance policy that I was selling was called Indexed Universal Life Insurance Policy. There's other ones like Whole Life, a Variable Universal Life. They have ones called an MPI, which are getting really popular right now. And basically the whole fundamental clause of it is the cash value is riding against the stock market. If the market went up, you would have the gains of the market, and when the market went down, you would have a floor of 0%, so you'd never lose money in your account. And so when we illustrated it for our clients, we would illustrate a rate of like 8%, which if you look at the stock market, typically averages 8 to 9% a year, 8 to 10% a year. That's not too bad. And the whole idea of if you could pull money out of it tax-free through a policy loan, it sounded like a really good idea. But if you had, and like what I did, I popped all the numbers into a financial calculator, the actual internal rate of return is where the devil's in the details. The internal rate of return is more about 4.5%, which is not as stellar. Still good, okay, but not as stellar as illustrated. And when I looked at policies that are mutual companies like Mass Mutual or Northwest Mutual, their internal rates of return are often quite a bit less than what was illustrated. On top of that, insurance companies keep changing. Insurance companies keep updating themselves depending on the variability of the market. So if a company is illustrating a certain percentage or a certain amount, they have a certain cap, but they have a guarantee over here, always look at the guarantee because that's the only thing that's really enforceable in the contract of your insurance policy. I've seen a lot of companies in the past demutualize, basically go from a company where it's for the policyholders to a company that's now publicly traded on the stock market, and the stockholders, or the policyholders, all their benefits would be chopped down to the skin of their teeth or down to the bone in order to maximize profit. So life insurance policies are typically utilized for death benefits. And can they be utilized for cash accumulation? Can they be used for profitable cash accumulation? Probably. But is it the greatest tool that you can utilize? Probably not, right? I don't personally recommend them. I recommend for young folks like you and I to buy a term insurance policy and invest the difference. Put the rest of the difference in a structured format into a Roth IRA or into a 401k or into your own savings policy that you can control, as opposed to leaving it in an insurance policy where, number one, you might not be able to touch the money for 15 years because of what they call a surrender period. Or if you want to withdraw the money without hitting your surrender charges where they take a big chunk of your money away from you, you'd have to borrow the money out through a policy loan, which now is going to eat internally at the cost of your policy. And there's a lot of charlatans out there. There's a lot of experts out there that are talking about utilizing life insurance to make a ton of money. To be honest, when you're looking at life insurance, you need to be looking at it from a 20 to 30 year perspective. And for most folks, that's not really an investment perspective that they're prepared to do. So again, my perception and my experience being a life insurance agent for a number of years, selling a ton of life insurance policies, now being a financial advisor in the tax space and a tax advisor, is the conspiracy is that these policies are designed to make insurance companies rich and to make insurance agents a ton of commission, but for the end consumer, like you and I, probably not the best bet. So I just want to put that out there. If you are interested or curious about any other conspiracies about money, or if certain investment ideas might be good or bad, I'm not an investment advisor, I'm a tax strategist, so please see your own professional investment advisor or your own tax person. But with that said, I would love to hear what your feedback is. I would love to hear what conspiracies about money do you want to hear about? Do you want to hear about taxation? Do you want to hear about the Federal Reserve? Do you want to hear about all that stuff? I would love to make those videos for you. If you're brand new here, don't forget to click subscribe and join us every single week as we put out like awesome financial information and also information to help you clarify your mental health when it comes to money. Again, my name is Eric. I'm your Abundant BFF. And as always, I'm here to help you find freedom and abundance. Don't forget to click in the comments and drop a comment for me. And with that said, I look forward to seeing you again soon. Take care. Peace.